I'm Sarah Borkson-Keeter with NAREITsREIT.com, and welcome to Quick Study, a monthly review of REIT market developments. I'm joined today by Brad Case, NAREIT's Senior Vice President for Research and Industry Information. Welcome, Brad.
Thanks, Sarah.
So if we could start by maybe reviewing how 2014 ended and what the fundamentals look like as we head into 2015.
Yeah, 2014 was a very strong year for REIT investors. REIT investors saw total returns of greater than 27% during the year 2014. If you compare that to the rest of the stock market, large cap stocks were up less than 14%. Small cap stocks were up less than 5%. So REIT investors did much better than investors in other parts of the stock market. Now that's of course very normal for REITs to provide better returns than the broad stock market. I mean, the average returns for REITs over the past 40 years have been nearly 13% per year. So REITs have traditionally provided a very strong total return for investors. But 27% return is not sort of the long-term average. If you look at where we are in the market cycle, you have to keep in mind that the real estate market cycle is very different from the stock market cycle. Stock market cycles tend to be a few years. The real estate market cycles tends to be 17 or 18 years on average. If you look at the last two real estate market cycles, the last one lasted 17 and a half years. And returns averaged more than 14% per year during that time period. The cycle before that averaged 17 years, and returns averaged nearly 14% per year for those 17 years. Here we are, if you count this cycle as starting at the peak of the market in 2007, then it's lasted less than 8 years. And given that the first few years of that was the liquidity crisis, REIT returns have averaged less than 4% per year. So I think we're still not that far along in this market cycle. And so looking forward into 2015, I can't say what returns are going to be, but I don't see any particular reason to see that to expect that they'll be less than the broad stock market.
And what do you think REIT investors will be focusing most heavily on in the first half of this year?
Well, I think there's a tendency to focus on demand conditions in the market. But the investors have to keep in mind that the real estate market cycle is driven mostly by supply conditions. And when you look at supply, construction in basically every part of the real estate market is still below normal levels. If real estate market cycles were driven mainly by demand conditions, then there wouldn't be very much difference between the real estate market cycle and the stock market cycle. But there is. As I mentioned, the real estate market cycle tends to be 17 or 18 years, whereas the stock market cycle is much shorter than that. The correlation between REITs and the broad stock market is only about 0.6. And so the reason for the diversification benefits for real estate is that the real estate market cycle is driven more by supply conditions. So although investors may focus on demand, they may focus on interest rates, what they really need to be focused on most, I think, is construction activity.
And do you think the REIT sectors that performed the best in 2014 will continue to hold those gains in 2015? Because
supply conditions are below normal in essentially every property type, I can't really say that I expect the sectors of the market that outperformed in 2014 to continue to outperform, but it's important to keep in mind that no sector performed badly in 2014. The weakest performing sector of the REIT market was timber REITs, which had total returns of around 8% per year. But most sectors were right around the average of better than 20% on the year. The best performing sector was apartment REITs, which had total returns of more than 40% on the year. And that's, I think, because of the demand for rental apartments in the population as a whole, coupled with, again, the low construction of new housing. But if you look at other segments of the market, equity REITs as a whole produced better than 28%, and yet their dividend yield is still more than 3.5%. So very, very strong income return, even though their performance has been so strong. With mortgage REITs, their total returns were nearly 18% on the year on average, and yet their dividend yield is still greater than 10%. So again, very strong income yield from REIT investments, whether it's on the equity side or the mortgage side, and very strong total returns on top of that.
Well, great. Thank you very much, Brad.
That's a pleasure.
And for more news and analysis on all things REIT, be sure to visit REIT.com.